Hey guys, I'm Chris and this is a Midlife Crisis Podcast. Welcome back everyone. Got an exciting show for you today. I hope you guys enjoy the content. If you do, make sure you hit that like button down below. Click the bell notification button so you're notified when new videos are showing up, and go ahead and leave a comment. Anything you'd like me to expand on or anything you enjoyed. I like hearing compliments, so if you want to throw one of those down there as well, that's great. Today we're going to continue on our Back to Basics series. Today we're going to be talking about credit. I'll move into the first slide here. So credit is your ability to obtain goods or services before payment, and that's all based on trust. The bank is trusting you that you're going to be paying them that money back, so they're going to lend you the money short term for a fee so that you can buy the things that you want or in some situations that you need. I guess it goes to show that I wouldn't recommend that you use credit for needs. Hopefully you have enough income that you're able to provide for your needs. Credit is a very expensive form of buying, so if you're using it for your needs, you're gonna that's how a lot of people get themselves into hot water. On the other side of credit is the opposite side, and that is debt. Credit is debt essentially, but I think that there's two sides of this coin that everyone needs to understand. So credit is the borrowing part. The debt is the state of being under obligation to pay or repay someone for something in return for something received. So a lot of people have this concept with credit that, okay, they have $500 available credit, so they have $500 to spend. But I think that one of the things that we need to do is make a transition into thinking of credit as a form of debt. So every time you spend $1, you owe $1. It's not like, okay, I have $499 left of credit. No, you owe $1. So that's, one of those concepts that I think people need to wrap their mind around so they can use debt responsibly and in a proper kind of way. If you don't really think about it as debt, it's a lot easier to spend that money and use it for things that, that you think you can justify. So there's three different basic kinds of credit: revolving credit, installment credit, and open credit. Now there are some crossovers between these different types of credit, but in essence, out there in the world of credit and finances and stuff, these are the three types that you're going to see broken down on a regular basis. And I'm going to kind of break them down for you here a bit. So the first type of credit is going to be revolving credit. So revolving credit is a line of credit that you can borrow from freely, but it has a cap. So a credit limit is usually what it's referred to. And you can use that credit at any time. Like a credit card, you can kind of spend on it, pay on it, spend on it, pay on it. Other types are personal lines of credit and home equity lines of credit. Now, one of the big differences between this type of credit and other credit is credit cards and things like that. They expect you to carry a balance. They want you to carry some sort of balance because that's how they make the money. They charge you an interest rate on whatever your outstanding balance is. And that's where they make their income. So the other thing to remember with this type of credit is this differs from other types because every month there is going to be a minimum amount due on your credit card. So that's kind of that's the kind of wrap up of revolving credit. The next kind of credit is installment credit. So installment credit is going to be more like a mortgage, an auto loan, a personal loan, and student loan. So installment credit comes in the form of a loan with a fixed loan amount, fixed payment, and established payment schedule. So a lot of times this will come in the form of a lump sum. You will get, say, a mortgage for $100,000. They're going to put it over a 30-year term. They're going to tell you each month you're going to pay a certain amount, and that's going to cover your mortgage payment, et cetera, et cetera. So that is the main premise of installment credit. This is really helpful for making big purchases, purchasing a car or purchasing a house. Your credit limit is set out, your credit cost is set out at the beginning of the term, so you know what you're going to pay. If it takes you 30 years to pay off your mortgage, you know exactly what you're going to pay in those 30 years for interest, and that's only if you have a set rate on your interest rate. I mean, there are different kinds of mortgages, obviously, that are going to be an adjustable rate. Some are going to have a balloon payment, but for the most part, for a conventional mortgage, you're going to have that cost set out for you for the whole term. Same with an auto loan, student loan, etc. So that's basically a wrap up of installment loans. So the last one that I want to talk about is open credit. So open credit is very similar to revolving credit. So you're going to see it on store cards and gas cards, and another form of open credit is actually utility bills. The big difference with open credit is generally the creditor wants you to pay that off in full every month. They're going to lend you the money short term. You're going to pay that off in full. So, it allows you to make repeated purchases up to a certain limit and then make subsequent repayments before the payment becomes due. So, a company like, say, Kohl's, they're going to issue you a credit card, and they want you to make purchases, but they don't want that balance outstanding forever. I mean, there are options. You can leave that balance outstanding, but they're going to probably charge you a higher interest rate for that because they make their business off of, short-term purchases. They're figuring, since you're only spending $40 on a pair of jeans, that you're going to pay that back, in a reasonable amount of time. Not like a credit card where if you had a $5,000 limit, you might carry a $4,000 balance on that all the time. And credit cards, that's their business, so they're okay with that. So the next subject we're going to move quickly into is credit scores. Now, this one is a huge, huge issue. A lot of people don't pay enough attention to the credit scores, and they don't realize what impact it has on their borrowing. A credit score is basically a number that represents a person's credit worthiness. So they're based on a whole bunch of different data, how well you pay back your debts, how much debts you have, how long your credit history is, and all that stuff kind of contributes. And the credit reporting agencies, there's three major ones. There's Equifax, TransUnion, and Experian. Those are going to be the three main ones. They take all that data and they compile it and they output a number. And that's what, when you go and apply for credit, that's what the creditor looks at. They look at that number, and that number is what they base whether or not, first of all, they're going to approve you, and second of all, what kind of fees and interest rates they might, impose on your loan or your credit card. So this is a little chart that kind of talks a little bit about credit scores and what they actually mean. So they're going to vary depending on the borrower you go with, or the credit reporting agency. They're usually pretty similar, but there might be a little bit of a fluctuation. So a credit score of 580 to 669 is considered fair. Anything below that is considered bad credit or poor credit. Those are actually going to have different numbers as well, but for this, I just thought I'd keep it pretty simple. Good credit, 670 to 739, and on and on and on. Exceptional credit, 800 to 850. If you're in this zone, congratulations, you're doing a great job. Most of us are going to find ourselves in the good, or very good down to fair kind of range. So now you can kind of see the percentage of people that have those different credit ratings. It's pretty even among the top three. There's not a whole lot of people that are considered poor and bad credit. It is a small portion. Most people, pay their bills, pay their credit card bills, and know enough about credit that they want to keep their credit rating good. So if kind of figure out where you are, where you need to be to get to the next level. I mean, if you can get to exceptional credit, you're doing great. So why is this important? Well, your credit score has a big impact on things. I mean, if you have bad credit, it's going to be hard to qualify for credit. You're going to pay higher interest rate, and you're going to have more upfront costs. So like for an example of the upfront costs, if you go to apply for a mortgage, they're going to want a bigger down payment. Same with an auto loan. If you have bad credit, they're going to want more money down because they're wanting to minimize their risk. With mortgage, they might expect you to, pay more for your private mortgage insurance. They're going to want you to pay, maybe have some kind of, escrow account, something that's going to, help them feel more comfortable about lending you money and feel more comfortable that they're going to get repaid for that. With good credit, on the other side, you're going to have a lot more choices. You can go to whatever bank you want. You can, instead of getting money from a finance company, you can get money from a bank instead, a conventional bank, which is, in the end, it's going to mean that you're going to get, a better interest rate. You're going to get less fees. One of the other things is when you're borrowing from a bank, when other people check your credit and they see that you're borrowing from a major bank in the U.S., they're going to say, oh, okay, well, this guy is, a little bit more trustworthy. If you're borrowing from finance companies all the time, people that are maybe subprime lenders, they're going to look at that and say, okay, this guy's quality of credit isn't quite as good as we want. Either we're going to deny him or we're going to charge him more fees. So financial security is another advantage to good credit. If you got good credit, if you get into a bind where maybe your debt gets overwhelming, maybe you have a job change or a life change that means your income goes down, or that that you have some short-term costs, you're going to be able to go out and you're going to be able to borrow that money for a better rate. If you have bad credit, you might not be able to borrow that money at all. So these are some advantages to having a good credit score. Anyway, I know I kind of flew through things there, but if there's anything that you want to go back and review, go ahead and watch the video again. Kind of look at the notes and stuff. I kind of outlined everything I talked about. Go ahead and leave a comment down below, and again, hit that like button and hit that bell notification. Let me know what you guys thought of the content. Let me know if you want to see more. I'll be coming back at you next week. We're going to be kind of continuing this Back to Basics series for a few more episodes, and we're going to be talking about some different things. Let me know what it is that you'd like to see, and I'll try and put together a show on that. Anyway, hope you guys enjoyed the content. Have a great day, and we'll see you next time.